Well, we are watching shares of Disney and After Hours on the back of their latest results. Disney expanding its cost-cutting plan after posting better than expected Q4 results. This coming at a time where media companies across the board grapple with industry disruptions. For the latest pulse on the media landscape, we've got Geetha Ranganathan, Bloomberg Intelligence Senior Media Analyst. Geetha, good to talk to you today. Certainly a lot of talk about where cable and the future of legacy media is headed at Yahoo's Invest conference yesterday. But I want to get your thoughts, first of all, on these results that we got from Disney. This company, like so many others, going through a transition right now with their legacy versus where their future streaming is going. What stood out to you in the results we got today?
Yes, the one thing I think that stood out at the very top was really the streaming numbers. It looks like they're reinvigorating streaming subscriber growth. I mean, remember, this is a company that had added something like 45 million subscribers in 2021 and 2022 after actually, launching their product. And then throughout this year, up until this final fiscal fourth quarter, they were actually losing subscribers. So the fact that they were able to actually have this turnaround and post subscriber numbers just on the back of a very, very strong content slate. We saw, multiple movies kind of coming to their streaming service. Elemental performed really well for them. We had the big Star Wars series, Ahsoka. So all of that obviously adding to that streaming subscriber momentum. But then more importantly, I think, was the fact that they are really now committing to streaming profitability. They've given us a timeline. They've said, expect us to achieve profitability by fiscal fourth quarter of 2024. And then it's just the overall business and the overall cost cutting is really in full force, because now they're going from $5.5 billion in cost cuts to $7.5 billion. So that is a pretty significant step up.
And Geetha, let me just click on the streaming service. What do you make of Bob Iger's overall strategy with that streaming service? I ask Geetha because we had financial analysts on Yahoo Finance this week, who cover Disney, and they were honestly still a bit confused about what the real overall strategy is for that service. Did that strategy make sense to you?
I think the strategy definitely makes sense right now, given that they are in the process of negotiating with Comcast to acquire the remaining 33% stake in Hulu. Disney already owns 66%. They're going to pay Comcast at least about $8.6 billion. It's a minimum price. Of course, there's still an appraisal process that is pending. But the idea being that they already have their Disney Plus product, which is, launched across the globe, working pretty well, appeals to, young families, young children. They have the Hulu, which is slightly more adult content, all the FX content kind of being on there, a product which has a very, very robust advertising business and can really help beef up that, digital advertising business for them on the whole. And then now, we know that they're going to go all in with the ESPN Plus, bundle. So you kind of put all of those together, and their bundle then becomes a really, really compelling must-have streaming product, a really good alternative to Netflix, because they will have that kind of four-quadrant appeal.
Yeah, and Disney announcing, of course, that they will transition ESPN to streaming no later than 2024. Disney's certainly not the only company right now only media company that's, sort of trying to decide what to do with some of their legacy assets. Yesterday's Yahoo Invest conference, we heard from Redbird IMI CEO Jeff Zucker, who, of course, used to head up CNN, on the future of cable. Take a listen to what he had to say.
Cable will be part of the landscape for the next decade. It will obviously continue to have fewer and fewer subscribers. But even at 45, 50 million subscribers, cable is still a very powerful distribution outlet.
So Jeff Zucker there saying that, look, cable is not going anywhere. We heard similar comments from Kevin Mayer, who used to be with Disney, of course, who said, look, even if you are seeing subscribers move away, viewers move away, the profits are still there. I wonder how you look at that in the context of where streaming is headed right now.
Yeah, I mean, this has been such a big question for media. How do you kind of navigate that transition from linear to streaming? You have to guard your linear profits because that's really the cash cow. I mean, you look at Warner Brothers Discovery, which reported earlier today, and I mean, Jeff Zucker was there. Warner Brothers, if you just kind of look at their profile, 50% of their revenue is from, their TV networks business, but 85% of their profits is from TV. So TV obviously is the lifeblood of so many of these companies. So it's going to be hard for them to kind of navigate that. But I do agree. I mean, I think we are kind of thinking of this pay TV floor. I mean, back in the heyday, it was 100 million pay TV households in the United States. That's down to about 70 million right now. But I think, yes, there is pretty much a floor. It probably will be 50 million. But the question is, are people there's going to be a lot of marquee content that moves away from the linear TV bundle to the streaming outlets. And so that is really what all of these companies are kind of trying to manage. Again, it's still a question as to whether, the streaming profits will be able to recoup the linear losses. I think that's what everybody's kind of really grappling with right now. Again, we have to kind of wait and watch. It's going to take a few more years for that to shake out, and I think there's going to be a lot more disruption before we kind of see light at the end of the tunnel.
And Geetha, turning back to the streaming industry, that's where the eyeballs are headed. There's so much competition there, though, Geetha. Disney, Apple, Amazon, Netflix. If you were to look at 3 to 5 years, Geetha, do you think all those big players are still around, or would you expect some consolidation? Could there be like a cable-like streaming bundle coming? What do you think is coming down toward us?
Yeah, I definitely think there has to be consolidation. I mean, you look at Netflix, of course, they're far away, they're far ahead of everybody else in the streaming space, 250 million subscribers. We see them going to 300 million just with all of their new initiatives in place, whether it's, the advertising tier, or the password sharing crackdown. Disney Plus, of course, is a close second. And I think just kind of with that consolidated streaming strategy and with their bundle front and center, I think they have, a really, really good chance as well. But then you come to like a Max, from Warner Brothers Discovery. They are kind of pretty much struggling when it comes to subscriber growth. They have achieved streaming profitability, which is, a really critical metric for the media companies right now. But as far as subscriber growth and subscriber scale is concerned, I'm not really sure they'll be able to exceed, let's say, about 100, 120 million. So what happens at that point? I think they will then have to consolidate with some of the smaller players, whether that's a Peacock, whether that's a Paramount Plus. We'll have to wait and watch. But ultimately, you're absolutely right. It is going to come down to rebundling, right? The bundle 2.0, which is going to be kind of this hybrid of the linear TV as well as the streaming services. We already kind of we got a little bit of a glimpse into that with this new Disney Charter deal, which is kind of this hybrid deal, not just for their TV networks, but also potentially for that ESPN full-blown streaming product that comes out in a couple of years.
Bloomberg Intelligence Senior Media Analyst Geetha Ranganathan. Good to talk to you today. I always appreciate the insight.
Thank you.